Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Friday, March 6, 2015. Looking at a daily chart of the SPY, and today was the bloodbath. So Dow was down 279, S&P was down 30 points, transports were down almost 100. They were down 96. And the list goes on. So across the board, markets were down anywhere from, for example, NASDAQ was down 1.1%, and the Dow was down 1.5%, and everything else in between. So what does that mean? Well, first off, let's go back a couple of weeks. And, for like 3 weeks, I was talking about a weekly cycle top. Well, guess what? The weekly cycle top ended up coming in at the last possible day. This was the Friday of the 1 week late, the plus 1 week of the weekly cycle, and that was the top. So it was late, but yet it came in anyway. And so what does that mean to us? What do we do with that information, and how can we make money with that information is the question. Okay, so the weekly cycle should last roughly between 2 and 3 weeks. So if the weekly cycle started last week, 2 to 3 weeks puts us somewhere in the neighborhood of the end of next week into the following week. Now, where is that actually? So next week is, let's see, we have a Fed meeting, I believe, next week. That could be a pivotal point for the markets. And then the following week is, and what I mean by that is you can see somewhat of a flush around the Fed meeting and the release. I think they're having a press conference next week, if I'm not mistaken. Those type of events promote a lot of volatility in the market, and you can see a flush. And where would that take us? And by the way, so the following week is options expiration, and the end of options expiration week would actually be a great culmination for the end of a decline in time, and the fact that it's options expiration week, usually you get a lot of game playing by the large big banks out there, and they can whip the market around, and they'll take it up and they'll take it down, and that would be just a good timing period for a culmination of a bottom. And where would a bottom be? So I have really like 4 areas. Okay, I've got 3 of them on the chart here, and then there's one more. So the first area is this gap window here, okay, which is right around 202.85, 86. So basically a pierce through 203. Okay, normally coming from this far away from a gap, normally on the first hit of a gap would represent a bounce in the market. So you could look for a bounce if we came into this area, but it may only be for an hour, a half a day, 2, 3 days, who knows? But usually you will get a bounce in this area. The second area would be the gap fill area, which would be right around, let's call it 202, okay, which is really only $1 lower from the other number. So what we're going to say is anywhere in this zone could possibly be a low. Okay. Now remember, I've told you that there are higher prices coming in 2015. Just because we had a bona fide bloodbath today, or a bona fide down day, distribution day, that doesn't mean we're not going to see higher prices in 2015. In fact, let me go over and I'll show you why. Okay, this is a monthly chart. There's nothing wrong with this chart. Okay, absolutely nothing wrong whatsoever in this chart. You've had plenty of months where intra-month or even the whole month you have a pretty good range, and right now this is nothing. So I just want you to put it in perspective, and you get a bird's eye view that there's really nothing wrong with this stock market. This is a bullish market, okay? So if we come down and test, maybe the first or second purple line I drew in, 203, 202, or even lower, where's the next level? Okay, the next level would be the low from last month, which was 107.86. We'll call it 108. I'm sorry, 197.86, 198, okay? So let's go back to the daily chart and let's get a picture of where that is, okay? 197, 198 is in here. So what that would mean, that was my third level on the chart, which is basically a pierce through of the 200 period moving average down to the low from February, and that would provide a really, really good level of support. Beyond that, we could come down a little bit farther into this zone here, but we're not ready to talk about that yet until and unless we see, a significantly higher level of selling pressure in the market. So for now, we're looking in this zone here, and if the market does find the bottom and it's the right time factor, meaning if it really comes in during options expiration week, I would think that that's going to be a pretty solid bottom, and I would look for bullish tone to set back in the following week. So that's what I see all in all in the stock market. Now, you had a lot of things going on today. You had the jobs number, and the jobs number, it was a good number, and good is bad. Good is bad for the stock market. Why is all this happen? Let me explain. Because the Federal Reserve has the keys to the interest rate market as far as the public's concerned, okay? Basically, the public is, and when I say public, I don't mean like the general public only. I mean the public meaning everybody. I mean the banks, the people that work for the banks, the investors, the pension funds, the people that invest in the pension funds, everybody. We're addicted to low interest rates, okay? So that being the case, each and every time that we start to hear rumblings about the Fed raising rates, and now are they going to raise rates in June, or are they going to raise rates in September? We're talking about a quarter, or maybe on the outside a half of a percentage point, or 25 or 50 basis points of a rise in the short-term Fed funds rate. What is that rate? That rate is what banks can borrow from the Federal Reserve at, okay? That's meaningless. It's nonsense. It doesn't mean anything. All the interest rates that you and I pay when we take a loan for a house, when we take a loan for a car, when businesses take loans, they're not benchmarked against the Fed funds rate. They're benchmarked against higher interest rate, longer term bonds, which are higher interest rates. So since we're on that topic, let's skip to the bonds, and then we'll backtrack to gold and oil. Okay. Let's go to the actual 10-year yield. Okay, the yield spiked up today. We're at 2.24%. Okay, right here. 2.24% is where we finished the day. Okay, now that's significantly higher, obviously, than we were just even a few days ago. Okay, but all these interest rates, business loans, car loans, bank loans, mortgages are benchmarked off the 30-year bond. A lot of other things are benchmarked off the 10-year bond, benchmarked off prime interest rate, which is benchmarked off the 10-year bond most of the cases and most of the time. So what you have is you have the bond market. Now let's go to the bond market. I'll bring up the TLT, which is the ETF that tracks the bond market, the 20 to 30-year bond. And the bond market sold off today, so money was running out of the bond market, okay? And normally, when money runs out of the bond market, it goes into the stock market. When money runs out of the stock market, it goes into the bond market. That didn't happen. They both went down together. Now, that's an interesting sign, because remember what I was telling you, okay? This is the daily chart. Let me go to the monthly chart. Remember this chart from last night, and I've brought this up a couple of more times, okay? This is a reversal, okay? Right up here, okay, is marking, or this will mark, a generational high in bonds, a generational low in interest rates. Where's the interest rate low? Well, it's worth going back to show you. Okay, well, I don't know if it's going to show you on this chart, because this is, this is the monthly chart, and the yield doesn't go... Oh, yeah, it does. I'm sorry. I'm looking at... okay, so this is the monthly. I thought it wasn't. So the yield here was... The low was 1.394, okay? That's in the 10-year, and that was in 2012, okay? Then you made another low here, or a low here, and you tested it here. These are generational lows. You're not going to see that again, okay? Well, go back to the bond market, or the TLT. Okay, this is coming back down. Now, nothing goes in a straight line. You're going to get bounces. And speaking of which, remember I was saying that the bond market is a buy. Okay, and where was I saying it's a buy? I was saying 124.25. Okay, and what we did was we actually came through 124.25, and I'll show you where we came to. I thought the market would stop on the downside here. Okay, I said this was going to be my downside target, and it was from this pivot high here. Now, if you go out even to a longer term chart, and this is rare that it doesn't stop at a weekly important pivot, where did we stop? We stopped at the high from 2008 at 123.15. The low today was 122.97, and we closed at 123.50. So basically that's a test of this high here. Interesting, because we just blew right through the weekly support, which was pretty good support. This is good support up here, okay? Under normal circumstances, this is pretty darn good. But we went right through it. At any rate, we're still in a zone here where there's a lot of support in this area. Not to say we can't come down more, but there's a lot of support, and I think yields will they may go up for another day or so, but I think that they're going to be due to pull back pretty soon. And let me give you my my upside target for yields, okay, from where we are now, okay. I would look, because we're so close, I'm going to look for a pierce of the 200 period moving average at 2.31, and your top end is going to be at 2.394, 2.395. That's going to be your top end for now in the yield market, and not to say we can get there all at once, but we should get there. Let's flip over to gold. And gold had a bloodbath today, and we were supposed to reverse this week, and it didn't happen. I'm going to give it another couple of days and see what happens, but there's still a lot of support down here, but it wasn't, it didn't, let me go over to the gold futures chart. It didn't, it just didn't look pretty, obviously. I just, remember when I said the range that we were in, 1200 to 1223, and the 1200 was down here, okay, and the 1223, I think we hit this high here at 1223, and then we started melting away, and then yesterday when we closed below 1200, I kind of indicated that that wasn't going to be good, that wasn't healthy, and we would see what happens. Well, obviously I didn't think that we'd have a $35 down day, but we had a $35 down day, and it was pretty ugly in the gold market, and it was all on the back of the bond market and interest rates and the Federal Reserve, and I'm not the Federal Reserve, the jobs number, and this whole mashing together of all the economic data, and so we'll have to see how it flushes out. But there's a lot of support here, and we are still in a bullish phase for gold, even though it's headed down. It should be making a turn shortly. We should have turned this week, and even if it's extended into next week, we should see a turn. So this should be a good buy for gold, but we're going to have to see. I'd really like to see a reversal pattern. In fact, let me bring up the GDX, because I want to show you, I see something a little different in GDX, which sometimes GDX will trade in front of gold. And GDX was obviously clobbered today with gold, but look what you had. You had a high volume day in GDX. You had 106 million shares of GDX traded. Average is down here at 48 million shares. Okay, so that tells me that GDX may have put in, I won't call it a bottom just yet, but this could be a bottom, and we'll have to see how it reacts. And what do we look for, right? This is why we don't guess a bottom is in. We're looking for the market to tell us what to do. We're looking for the market to signal that there's a bottom in place. We're looking for a reversal bar. We're looking for a doji candle. We're looking for to make another low and then reverse and finish on the highs for the day, maybe engulfing this candle here. We're looking for some signs of the market putting in a bottom. Does that mean we're going to catch the low? No, probably not. I don't need to catch the low. What I need to do and what you need to do is catch the highest probability trade you can, which means you wait for the market to tell you it's time to get into the trade, and while you might not catch the bottom, you normally will be more right than wrong, and therefore you'll make money more often than not, and you know where you're wrong, and that's the most important thing. Knowing where you're wrong and minimizing your risk is more important most of the time than being right. Right? We want to make sure we keep our losses small and let our winners run. And that's the name of this game. And that's how you make money in this business. Let's go over to the oil market. And oil got clobbered today with everything else. Not much doing here. Oil is basically just trading. Most of the time it's just trading inverse to the dollar. Dollar up, oil down. Not to say it doesn't disconnect from time to time, and I'm not saying they're 100% correlated. I'm just saying more often than not, the dollar is trending in the identical opposite direction of oil. So right now you're still in this range, and you're coming down to the bottom end of this range, okay? And the top end of this range at about $55 is your upside target for now, or your upside maximum really for now, unless you bust through it. And there's really nothing to do. We had the trade earlier in the week, the round tripper. We talked about that almost every day. But right now, there was no trade on yesterday. There's no trade on now. We have to wait for oil to tell us, what it wants to do. Right now, it's just chopping around. It's in this range. And while it's in this range, it's very difficult to trade. It's really directionless right now. There's no trend to be followed in oil. And unless you see a trend, it's hard to pick a trade out. All right, what else do I have here tonight? You know what? There's one more thing. Interesting development today between Apple and AT&T. So Apple, you know what? This is worth talking about a little bit more. So Apple, remember I was saying when NASDAQ was hitting 5,000, Apple was selling off and it was melting away. And I said, and I've even put the title of the video a few days ago, NASDAQ 5,000 without Apple. And that is the case. So what happened was Apple started selling off and Apple started correcting before the market started correcting. And that's normally a tell, right? And we talked about it. That tells us that something just wasn't right. Apple should have been leading the market higher, and it wasn't. And that was certainly a signal that there was trouble on the horizon. So basically, if Apple could come down and maybe get to this 50-period moving average, Apple would be a good buying opportunity, because if the market's going to lift higher into 2015, and I think it is, then Apple's going to go with it. And Apple probably has upside to 140, maybe even 150 if we got what we'll call it a euphoric rise in the market. And, it's possible. So Apple's coming out with a watch announcement on Monday. I don't know what's going to be with that. Who wants to wear a watch that you can talk into or see a date on? Who knows what that watch will do? It doesn't really matter. Let's put AT&T up on the board, because this is important. Apple replaced AT&T in the Dow. And it's going to happen later this month. Actually, I think it's going to happen around options expiration late that week. I think maybe the 18th or something like that. So Apple replaces AT&T in the Dow. And here's what I want to tell you about AT&T, okay? There's nothing wrong with AT&T. AT&T pays over a 5% dividend. AT&T is an enormous cash cow. Yes, they have a lot of debt. But the reality is that the fact that AT&T was removed from the Dow and will receive negative press as a result, okay, and already has, all right, this has happened before, and it'll happen again. But what I'm here to tell you is that on this sell-off, if you can get AT&T down in these lows here, okay, where there's a lot of support, let's call it 32.33 area, or 32.50 area. If you can get AT&T down another $1 from here, okay, you want to be a buyer of AT&T, and here's why. Because make no mistake about it, the institutions that manage money and manage stocks for yield and for income and bonds, okay, they will be and are buyers and are holders of AT&T. They will continue to buy because when AT&T gets down to $32, it will be paying a 6% dividend. And make no mistake about it, plenty of institutions, money managers, and people will be buying AT&T for a 6% yield because it is a cash cow. Therefore, you can ride that train and probably ride it back up to the top end of this range while the market inflates sometime in the next, we'll call it month or so. I would expect the market to take off to the upside and put in a nice rally into the summer months of 2015. So that's where we are. I'm going to leave it there tonight. It's a wrap. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.